What is up, YouTube? I'm Adam Odell, Chief Investment Strategist at moneyandmarkets.com, and I'm joined this week by my research analyst, Matt Clark, and we're here for another episode of Ask Adam Anything, where the title is fairly straightforward. You can ask me anything on your mind about stocks, commodities, bonds, portfolio management, what's going on with the economy, what's going on with the market. I don't know everything, but I'm a student of the market and the economy and history, and I will give a thoughtful answer to any question you throw our way. So with that said, I think you have a question from one of our readers this week, Matt. I'll let you take it away.
Yeah, thanks. We're going to keep this really, really simple. We're not going to ignore, where we're at today in terms of the market. And the question is very straightforward. It's not necessarily very easy to answer, but I think it is one that a lot of viewers are worried about. In fact, I think there's millions of Americans that are worried about that. And that is the fact that we are in a bear market. There is no ifs, ands, or buts about it. That is where we are today. We may see a day pop up, but then it goes right back down the next day. That's just where we're at. And I guess the question here is very simple. What can we expect from this bear market?
All right, so what can we expect from a bear market? That's a great question, and I actually did a lot of analysis on historical bear markets for my subscribers. I run an options trading service where we actually play both sides of the market. We can make bullish plays and we can make a bearish or short plays, by buying options, which are risk limited vehicles. So you can put, a couple $100 into an option contract, and that's the most you can lose. But on the upside, you can gain, many multiples of that. So it's really a shorter term, nimble strategy that allows us to play both sides of the market, which is key in this environment. So the name of the game with a bear market, which is kind of an arbitrary label, is just to be flexible, to be able to play both sides of the market, to be able to have patience, to have a watch list of stocks that you want to buy when you feel like the bottom is in and the valuations are low enough that you can enter a stock at low enough valuation that gives you a good margin of safety. But of course, finding that bottom in a bear market is difficult. And, the analysis, Matt, that I shared with my subscribers at Home Run Profits is, I looked at it three ways. What is the quote unquote typical bear market? And, spoiler alert, I'll give away the lead here at the top. The conclusion is that there is no typical bear market. I'll give some averages, but the variability or the range of high and low and short and long around those averages is so wide that it almost becomes useless to say, the average bear market lasts 11 months. But, on that note, I looked at the length of the average bear market, the depth of the average bear market, and the time to recovery from the average bear market. So which one do you want to take of those, Matt, first?
Dealer's choice. Let's start with the average recovery time.
Okay, so that would assume that we've already hit the bottom, and I don't think that we have necessarily hit the bottom. And I'll show you why in a moment. But yeah, let's say we hit the bottom, and first of all, at the bottom, the bottom is always dominated by a palpable feeling of despair, a loss of hope, hopelessness, the fact that everyone feels like stocks are going to go to zero, that the stock market is going to cease to exist, that the economy is never going to recover. It's really the darkest day type of feeling at the bottom, and it's counterintuitive, but that's really the sentiment you want to look for to figure out that we've hit the bottom. And I don't think that we're quite there yet. Certainly, consumer sentiment is at a multi-year, multi-decade low, and folks are certainly worried. There's been a lot of selling in the stock market, but it's kind of been this early first or second wave of selling. It hasn't really been the not to be crude, but the puke your brains out type of sell-off where everything just gets sold and, another 20 or 30% down, when everybody loses hope all at once. So nonetheless, back to your question, how long does it take the average bear market to recover? And I measured that from the low of a bear market in hindsight to when that next rally or that next bull market made new highs, so exceeded the high of the top before the bear market. So the average of that it can be several years. Some of them are really, really short. In 1980, the 1990, and the 2020 bear markets, those recoveries were very quick, 3, 4, and 5 months. So again, in the Corona crash, March 2020 low, we recovered the February 2020 highs within 5 months. And that was one of the faster recoveries. But again, in 1980 and 1990, there were some mild bear markets that recovered in 3 and 4 months. But that's kind of the exception. If you remember the 2008 bear market, it took 49 months, just over 4 years, to recover the highs from October of 2007. The dot-com bust at the turn of the century from 2000 to 2002, that was also a lengthy recovery of 56 months. And then the 1973 bear market, it took 69 months, so over 6 years or almost 6 years to recover from that bear market. So the message here is that, bear markets are somewhat short-lived. Usually the drop is faster than the recovery. And that recovery is kind of tough because until you see the market make new highs, you're never quite sure if the bear market is over or if it's going to be another leg down. So psychologically, that's tough. So road to recovery is going to be a while, and you do have to trade differently in a recovering market than you do in a confirmed bull market. But nonetheless, we have the average length of the drop and the average depth of the drop. Which one do you want to hit next, Matt?
Let's go with the length of the drop.
Length of the drop. Okay, so basically, stocks topped in the first week of January. So that's why if you look at, and went into a bear market in the early part of the second quarter. So really, I mean, if this is why stocks are said to have their worst first half since 1970 or so. It's been quite a while. This is
before
also
I was born.
Yeah, me as well. It's also been the worst first half of the year for U.S. Treasury bonds. Going back to like the 1780s, I believe, the late 1700s, which is phenomenal. And the thing with you've probably heard of, Matt, I'm sure, of the 60-40. Most of our viewers have heard of the 60-40 portfolio, which is 60% of your assets in stocks, 40% of your assets in bonds. And the idea of that is that, one, bonds are less volatile than stocks. So that makes your whole portfolio a little bit more stable. But even the more important key to that portfolio in theory, and in most times over the past several decades, is that typically during bear markets in stocks, when stock prices are going down, bond prices are going up. So you get the diversification there, that those are not correlated assets. This is really one of the first halves in a really long time where both bonds and stocks at the exact same time have dived lower, in double digits. So it's really been a tough first half for a lot of traditional portfolios. But back to the question, since 1950, the average bear market from top to bottom has lasted 11 months. So if you think about it, the top was in January, we're now in July, so we're just over 6 months through this drop. And if you go on the average, if you think that this bear market is going to be average, we have another 5 or so months before we will see the bottom. That said, if you think that this is going to be a larger or longer bear market, a more difficult one, it could be even longer than that. So the average is 11 months. Again, the shortest drop ever for a bear market was the 2020 Corona crash. It's easy to say that that was more of a shock globally because of a health pandemic rather than a markets-related bear market. Nonetheless, it was a bear market. The longest drop was the dot-com bust. It was one of the longest. So from 2000 to 2002, that from top to bottom took 30 months. So it was 30 months of declining prices before that bottom ultimately hit. So obviously the depth of the drawdown really wears on people's psyche, but so does the length of the drawdown. I mean, it was pretty easy to manage a 1 or 2 or 3 month drop, when we saw a very short one in the 2020 Corona crash. But when that drop, when you don't see the bottom when you see successively lower bottoms over a 1, 2, 3 year period, almost as we did during the dot-com bust, that can certainly wear on your psyche. So Matt, we've done 2 out of 3. So the next one is the depth. Again, I was looking at the S&P 500, mostly a bear market since 1950. The average drop, you want to give it a guess, Matt?
The average drop of the S&P 500 in a bear market, I would say 35%.
You were very, very close. It's 30%. So you just overshot it. But yeah, basically the average is 30%. And obviously for folks who don't know, the definition of a bear market is arbitrary. It's a 20% drop from the latest high. So we crossed over that recently, but yeah, the average is a 30% drop. So it's not that much more than just crossing into bear market territory at 20%. Nonetheless, I mean, there's a huge amount of variability around this. So in the fourth quarter of 2018, we technically had a bear market for like a day or two. The S&P 500 was down either 20 or 21%, so just barely crossing that arbitrary threshold. The bottom came on December 24th, Christmas Eve, and that was the bottom. So it was like, very quick and very shallow bear market that almost really wasn't called a bear market. We also had a near miss in 2011. In the summer of 2011, the U.S. Treasuries, U.S. debt got downgraded by the ratings agencies, and the S&P 500 fell 19.4%. So it just missed the bear market threshold by a hair. So that was never called a bear market. Nonetheless, folks took losses during that period, or took drawdowns at least. So there were mild ones, there's near misses, but then, 2008, the S&P 500 dropped 57%, 56.8 to be exact, I believe. And then during the dot-com bust, the S&P 500 was down 49%. Of course, the technology-heavy NASDAQ 100 index lost a lot more during the dot-com bust, 83% for that index. So again, the take-home message here is that we can talk about what the typical or average bear market does in terms of length and depth and road to recovery, but really each bear market is different, and there's so much variability around the historical ones, and each new one is brought about by new calls. I mean, Matt, you and I were chatting before we started recording that the past 4 decades, all the bear markets and bull markets have been against the backdrop of a disinflationary environment where interest rates have been steadily declining since the early 80s. And in some cases, we've even had deflation during the shocks. So that's a much different backdrop than an inflationary environment where the price of consumer goods and energy and home rent prices, everything is going higher. So that creates a whole new calculus for what stocks and bonds do in a bear market. So you really can't look at the last bear market and try to fight that war, so to speak. You really got to focus on what's happening in reality right now. You have to use a system that gives you rules that allow you to get back into the market or to put on your risk management sells when the market takes another dive lower. And you really have to be flexible to play both sides of the market. And that's why at the top I mentioned my home run profits trading service. We buy options. So it's a risk limited strategy. And we buy call options when we find plays that are bullish, and we buy put options on stocks and ETFs that we think will fall in price. And that allows us to kind of escape the mercy of buy and hold, so to speak. So we could certainly point some viewers there if you're interested in that.
Yeah, we'll put a link up top on our YouTube video so you can find out more about home run profits. But yeah, the bottom line here is you cannot look at all bear markets are not equal. They're not. In fact, none of them are not one is the same as the other. You cannot point to one bear market dating all the way back to 1929. There's not one bear market that is the same as the next. They are all very unique in their rationale and how they got there. They're unique in how long it took to get there, how long it took to recover, and how far they actually went down. So, to say that maybe we've hit a bottom, well, quite honestly, nobody really knows that. To say this is only going to last a couple months, nobody really knows that. To say this is, we're through it and we're back up. Again, nobody really knows that. You've got to see more confirmed information before we can say, okay, now we're on the road to recovery. And I agree. The key thing here is first off, don't look at your portfolio every day, because that's just a stress point. Don't look at it every minute. There's no point to it. But also, make sure you do have a system in place. And I think, like you said, home run profits is a great way to do that. We look at both sides of the market, both the bullish side, the bear side, and we have ways to profit in either one of those markets. So definitely would encourage people, if you're not already a part of our home run profit service, to do that. Again, we'll put a link up top here. And again, if you do have a question about a particular stock, maybe a sector, the economy, anything like that you'd like to ask Adam or Charles or myself or any of our videos that we have here on YouTube, do so. We would love to hear your feedback. You can let us know. The email address is actually ironic. It's feedback@moneymarkets.com. We'll flash that down there so you can get it. You can also comment below on our YouTube channel. Maybe you've got a story about maybe you were in the .com the .com bust. What what happened? What happened to you personally? People would love to hear that. We would love to see that. I think it's something that is, again, at the forefront of everyone's mind who is involved in investing, is the fact that, we're in a bear market. This is unlike any bear market we've ever seen, because then you also have to tack on inflation, also being a driver there as well. So Adam, I think good all the way around to educate people on a bear market and to really let people know that you can't really compare one to the other and suggest that this is going to be just like that, because it hasn't happened since bear markets really became in vogue in 1929.
Yeah, and you can't put your head in the sand either and pretend that it's not here or that it's just going to pass. Now a bear market isn't necessarily good or bad. It's just what you make of it. The first step is acknowledging reality in any problem solving or challenging environment, is to acknowledge the reality and figure out, what has historically worked, what are my core principles when it comes to investing, and sticking with that discipline and having patience and having humility. That's really what we're about. I mean, our money markets franchise is built on this idea of adaptive investing, and the fact that we are not, one-trick ponies. We're not wed to one particular type of stock or particular direction. We are market students. We are humble, advisors of, and we do research that we feel is beneficial to our readers, and we share that with humility and an openness to be real and transparent, and that's really what will allow us to not only survive and thrive throughout this time, but come out ahead at the end. So that'll be my parting shot.
I think that's good. I think that's a good way to close it. Good. Look forward to doing it again next week. It's been a while since we've been on. It's like I raised you. I mean, you don't call, you don't write, nothing. It's strange. I kid. I know that everyone has been very busy. No matter what the market is, we are always very busy in what we do, and definitely want to make sure everyone checks out moneymarkets.com as well. That's where Adam, Charles, myself, and our entire team, we work hard to find those profitable opportunities for you in any market, and it's right there at your fingertips for free. You can use our proprietary stock power rating system, get the ratings of thousands of stocks. We rate things on 3 fundamental, 3 technical metrics. You can see all that. You can use all that, create your own watch list, track your stock performance, do all that for free at moneyandmarkets.com. Adam, look forward to doing it again next week.
Likewise, Matt. Thanks so much.